Hi, I'm Dan and welcome to Pay Down Debt Solutions. So you guys see lots of videos. You've seen us do lots of videos where I show you the math step by step. That's more of like a proof of concept, if you will. I'm proving to you, showing you the math of how it works, how the numbers actually, the income going out and the bills coming out, how those numbers actually work to pay down your debt faster. But that's usually not what people struggle with. It's just simple arithmetic. What most people struggle with is the actual concept of how to move their finances around when the paychecks come in and when they have bills coming out. So I'm going to show you an example using the same income, and it's all just made up. This isn't anyone's example because it's arbitrary. What all the numbers are is arbitrary. Once you go through and check, say with the math like we show you, like, yeah, this will work for me. Actually moving the money around is more what I want this video to focus on. I want people to really see the steps. That's usually what people struggle with, and that's what they're most tentative about. It's what they're most fearful about. If they move money wrong. And there's only one, once I show you the examples, there's only one warning, and it applies to both, and I'll cover it as soon as we get to it. So let's get right into it. So let's say you have a person, let's say they make $5,000 a month. And now the way velocity banking works, it doesn't matter if it's $1,250 per week, $2,500 every 2 weeks, every $5,000. If you're already paying your bills, you know this will work because you're already paying your bills. You already know the frequency your checks are coming, the frequency your bills are coming out. You absolutely should map that on something like a spreadsheet, whether it's in Excel or you do it at home. Map it, know exactly. And also in the process of mapping, you're accounting for every single dollar that's coming in and out. We'll never stop, iterating it and reiterating it so everyone understands it. So let's say they make $5,000 a month, right? Let's say their expenses, we'll just make it 5,000 equal, right? Let's say we got a zero cash flow person. And now if they have to use a credit card, and I'll do an example with the line of credit versus the credit card, they'll have chargeable expenses and non-chargeable expenses, right? So let's say their chargeable expenses are $3,000. Their non-chargeables, $2,000. Right? So zero cash flow. Sorry, you got bug bite itching. Okay, so you'll see Jen say HELOC a lot. You'll see me mention a few times. I always say at the end of the video, always align, never alone. And one is, you'll hear it again and again, a loan, if you owe $10,000 on your loan and you paid $5,000 of it off, it doesn't matter to you. You still got $5,000 to pay. You can't access that $5,000 you've already paid. With a line of credit, let's just pick a credit card. Credit card's a line of credit. It's just not what we mean for our examples today or in general how we do our videos. But if you had $10,000 in your credit card and you paid $5,000 of that credit card off, so you got a bonus at work, you put the whole $5,000 on there. And you did it even though you're like, man, I'd like to have $5,000 in my savings account. What if something happens? What if there's an emergency? Now, losing your job is having to pay rent, cover rent so you're not homeless. That money, absolutely. You decide for yourself what you're comfortable with. There's all kinds of rules of thumb you can look up online. But if you have that already, or you just simply, it's not a concern of yours, the advantage to the line of credit is that $10,000 you paid $5,000 on, you've still got $5,000 of purchasing power in that credit card. That $5,000 off the loan can't do anything for you. But by using a revolving line of credit like that $5,000 you paid off, you have $5,000 available funds to use in an emergency. That's just something you should be aware of. You're not locking yourself into something like you are with a loan when you do the systems. You're doing it on your own at home. So let's get into what I started with, why we're always talking about a personal line of credit, business line of credit, or home equity line of credit. It's a slight advantage over the credit card, not a major one. But what the advantage is, it makes your job easier. So what you're going to have is your checking account, right? And you're going to have your line of credit. Yeah, sorry for the... I got a heavy hand, so I scribble a lot when I got something slippery like a dry erase marker. So this is your checking account. I'm going to fix that and make it bigger so there's no mistaking it. Right? So here's your checking account. Here's your line of credit. Ideally, these are linked. If they're not linked, it just adds an extra step. Now you really got to drive somewhere. You don't want to do that. You want to if you already have a line of credit and it's not where let's say your personal banking's done, where your check's being deposited, go open a checking account where that line of credit is, start getting your paychecks direct deposited there, at least until you get yourself debt-free. So this is what's going to happen with your line of credit. Whenever it doesn't matter your frequency of your paychecks, like I said earlier, your paycheck's going to get direct deposited to your checking account. Right? As soon as it's direct deposited, cleared, you take all of that balance and you transfer it to your line of credit. Personal line of credit, business line of credit, home equity line of credit. And you let it sit there. Because this is the advantage. There's numerous advantages, but they're all small. And they all add up to something big, getting yourself debt-free and saving you money. So that money sitting in your checking account, even though it's very low interest to you, the banks not just get loans, but they also earn interest on their total deposits, like if they maintain an average. So that money sitting in your checking account is paying the bank interest. They're earning money on that. Obviously, they're not earning as much as like when you just have it sitting in a savings account, because that's why they pay you more, because they earn more interest in that money in the savings account. This isn't a banking lesson. This is how to structure your finances, how you actually move your money around to do velocity banking. So, sitting in a checking account pays the bank. Pulling money out of your checking account, put it into your line of credit, using your line of credit as your debt destroyer, keeps interest in your pocket. By lowering that balance and how do I say this? I've said it in numerous other videos. I'll say that a lot. So I'll just say, lowering your balance in your line of credit lowers your average daily balance, which is how the interest is calculated they're charging you. So here, interest goes to the bank. You put it in that line of credit, the interest stays in your pocket. More interest stays in your pocket, right? But you got bills that'll come due, right? We all got the bills coming due. So let's say you got bill number 1, bill number 2, bill number 3. And it's all arbitrary. We're just going to pick this. This differential is more about when I show the credit card next. If you're wondering like, hey, why isn't it showing 5,000? Why aren't these bills adding up? They're not supposed to. This is just an example of how you move your money around and when to move your money around. Right? Oop, I'm playing soccer with the cat. All right. So let me get some nice colored markers. Jen loves colored markers. So you got your paycheck, went to your checking account. As soon as it cleared your checking account, you put it in your line of credit. That money's just sitting there because while it's sitting there, it's saving you on interest. But you got bills due. So let's say this one's due. Let's say the 5th of the month, 10th of the month, 15th of the month. Right? Everyone's bills are spread out across the month. The old days was always like the 1st of the month stuff was due. So on the 5th, when you have bill number 1, $100, you're going to take that $100 from your line of credit and you're going to move it back. You move it back to your checking, because from your checking, you can pay it however you paid it before. This is the convenience part of having a line of credit available. Personal line of credit, bank line of credit, home equity line of credit. Having it available, because once it hits your checking account, you pay that bill however you used to pay it. Auto pay, auto withdrawal, mailing a check, whatever it was. So that you bring that $100 back when you got that bill due, back to your checking account, and then from your checking account, pay that bill. All the remainder is still sitting there, still sitting in that line of credit, keeping your average daily balance as low as possible for you for that month. So now the 10th is coming up. You do the same thing on the 10th. There's the 10th. You transfer that $200, goes in back, you pull it back, transfer it back to your checking account, and you pay bill number 2, however you were paying it before. And I'm sure you all know 1, 2, 3, it's not lawnmower surgery, as I like to say. And that's kind of an inside joke. I got an 8-year-old daughter. She goes, Dad, it's rocket science. I'm like, honey, to some people, rockets are like magic. I don't know why I'm beating this, probably because I'm a dad, I'm beating this joke to death. But she just looks at me like I'm insane and just died laughing. So it's lawnmower surgery instead of rocket science, or rocket surgery if you prefer. Anyway, let's get back on it. So here we are. Well, not seeing the color I want. Give me a sec. Here we go. That one's good. Right, so bill number 3 is due on the 15th. That's when you take this over. You transfer that $300, take it out of that line of credit, back to your checking account. Pay bill number 3. It is that simple. And the big advantage, you'll see how big of an advantage having a line of credit is over a credit card. Both will get you the same place. This is just a little bit easier. And you'll see that when I get to the next example of a credit card as your debt destroyer. So right, let's just say it's 1, 2, 3 bill, we're through the month. Well, the next month starts, or it's 2 weeks later, your next paycheck. Same thing, paycheck goes in, put in your line of credit, it sits there until you pull each amount out to pay each bill. This is the mechanics of what you're going to do when you have a line of credit with your paychecks coming in. And like I said, it doesn't matter if it's monthly, bi-weekly, or weekly. Just keep them going in. If you're already paying your bills, you're just going to keep paying them this way. And now your line of credit. So this is like, oh, hey, I just got a line of credit to pay off. It's not like that. So what you're going to be doing with your line of credit is over here you got credit card 1, credit card 2, credit card 3 that you want to pay off. Those are just like these bills. Think of them just like these bills. Heck, I shouldn't even have written them over there. I'm going to write them right down here because they're always there. And you're always paying the minimum on them. Even though you're doing velocity banking, until that balance is 0, you got to pay your minimums. So let's add these to your regular bills. CC1, credit card 1, credit card 2, credit card 3. We just like bill 1, 2, or 3, you're already paying the minimums on these. So this is the warning. This is the one caveat to this system where you just got to pay attention. When you are ready, when you look at your checking account, not your checking account, your line of credit, you're like, okay, I've got enough room now. I can pay off a credit card. Now, when it's credit card to credit card, we say transfer a balance, move a balance over. That's not. You're just going to have enough room, have enough available balance in your line of credit to pay one of those off. The warning. You've got to time it. You don't have to time it perfectly. You just have to be careful that you haven't. Let's say you're getting near the end of the month, so you've paid most of your bills, but not all your bills. Say you got another 1 or 2 big bills left. All right? And you've got, well, I can't even use these. I can't use the dollar examples because it's more about paying 1 or 2 bills. But if you've got, let's say, 2 weeks to go, and you still got a big bill, but then you're like, hey, if you don't remember that bill, each week you're taking your checking account not to 0. Oh, that's another little warning. You don't take every single penny because you've got to keep your checking account open. You know I'm charging you a fee. Check your statement. Check with the bank. What is the minimum? Is it a $100 minimum? $150 minimum? It's usually pretty low. So you're always maintaining that in here. You always got to maintain your minimum. Right? Let's just call it 100 on that. So you got 100. So let's say this line of credit dropped. Let's say it dropped to $2,000. Right? This credit card's got $7,500 on it. $7,500 balance. You've got $2,000 on it. It's a $10,000 limit. Right? Total available. So you've got $8,000 in room. So you're thinking, heck, I'm there. I got it. So you move that money to your from your line of credit to your checking, and my voice cracked. Then you pay that, right? So now you're showing, now you got $9,500 for a balance in this, and you've got $500 available. $500 available in your line of credit. You've only got $100 in your checking, and you're like, yes, I just paid that credit card off. But if you're not, it doesn't matter if you're a day or a week to your next paycheck. If you've got a bill due that is greater than, we'll say 600, because to avoid, say slow paying something that might ding your credit, you've only got $500 available in your line of credit. You've only got that $100 you're keeping in your checking account to avoid a fee, for dropping below a minimum balance. So when you time it, the best time is after you've paid your bills for the month and right before your next paycheck. Because just think, if you didn't, like I said, say you got, just pick anything. Say it's car payment. Say it's $800 car payment. If that car payment if you just paid this off and you got excited, but then you're a week from your paycheck, but in 2 days you got an $800 car payment, you're locked. You don't have the money. It's a car payment, so you can't use your credit card to pay it. You just stuck yourself. I've yet to see, this isn't groundbreaking. Everyone that shows you velocity banking knows this. I've just never seen anyone tell you that. They say, hey, bring the transfer over. Well, you got to be careful. There is a scenario where you get yourself, you've maxed out your line of credit, you don't have enough checking account balance, and you still have another bill due. And you're stuck, especially if you can't use a credit card to pay it. Like that, you're stuck if you can't use a credit card to pay it, because that's all you'll have available. If you don't, presuming no savings, no check, no other savings accounts or things like that. Yeah, you just stuck yourself you catch-22'd yourself. And the same goes. But this is it. This is the line of credit. Now, I'm going to do the credit card next. It's not vastly more complicated. It requires like 1 or 2 extra thought steps to pay attention and plan for. So let me erase the board. And this is where the 5,000 comes in. Not so much that, but more the chargeable and non-chargeables. So, one thing that doesn't change, paycheck goes into your checking account. Right, and over here you got your credit card. And now you've got chargeable expenses, non-chargeable expenses. So now your paycheck's gonna come in. And we're gonna make it easy. You guys know, like I said before, weekly, bi-weekly, monthly. You just keep putting them in. If you're already covering your bills as they came, if you're slow paying, as you pay down your debt, using Velocity Bank to increase your cash flow, you'll start to have a little extra money in your checking account. And that will get you over the gaps you've already had. We have a couple of people where they just weren't quite making their minimum. They knew they were digging the crap, but they didn't have the cash flow. What are they going to do? But more often we get people are just barely making their payments. Sometimes they're a day or two late. And they're consistently, it's not like once in a while, it's consistently because they're either right at zero or just a little negative. So it's all about timing. It's like if they're getting paid every Friday, well, when's their next payment due? What's you get that little grace period, you get it in the mail, you got 15 days. When's that 15th day? If it's 2 days past their paycheck, they get slow pay. There's no fighting it. You already know you're tight, you're already stressing. It's terrible. I've lived it with Jen. But as you start paying down your debt, whether it's this or the line of credit, you'll start seeing you'll have some residual money left over. Oh, I left something out so important in the line of credit. When your line of credit drops below your expenses, you reach that point where now you're paying off that bit of the debt. So let's say let's just erase this so you guys go to the board. Right? So let's say your line of credit, right? As soon as that is less than that $5,000, let's say $4,900, you're going to pay interest on an additional month. But after that, you're putting under that $5,000, you're putting $5,000, but you only got $4,900 balance in it. Well, you're not, because if it's as you're dropping this to zero, you can't pay your line of credit down less than zero. So when this drops to like $3,200, let's say, that was a little too close. Let's say your line of credit now you got down to $3,200. But where did it start? You're not going to reach it exactly, right? You're not going to reach 5,000. Oh, exactly at 5,000. But it doesn't matter. Same example. When you hit 3,200, and that's, let's say, remaining balance, let's say balance owed. A lot of people get, even Jen and I, I've told it in 2 videos. Jen probably told in a couple of videos. We just got ourselves caught just not paying attention to whether it was available balance, current balance due on a line of credit. So let's say you got $3,200, right? You came up positive on the cash flow. You've been working it down. You reach $3,200. You can't put $5,000 in there. You're only showing a balance due of $3,200. So you're just going to keep $1,800 here and pay that $3,200, right? And then now that's zero. Once you can hit that zero on the line of credit, you don't have to move money back. Essentially, once it drops below the 5,000, you'll have to work it because you still got the money there, but you're already paying everything out of your checking account. So essentially, just putting less in there, and you just keep paying the bills out of your checking account. And it won't necessarily line up perfectly. You know, you only owe $3,200, you got, you know, $1,500. It doesn't matter. Where the numbers are doesn't matter. Just keep paying your bills, just like I showed you before. You know, right out of your checking account for all your bills. You only are trying to pay this down to zero. You can't pay it lower than zero. So each month, once you pass this threshold on your total, because you know you can get your line of credit, whatever your limit is, right? Earlier I said 10,000. Well, you're going to work the system until that 10,000 hits 5,000. After lower than 5,000, because that's all your bills are going on there anyway. You're just going to keep paying it down. And I hope I explained enough different ways that it covers just about everyone understanding it, the system. Okay. So let's take it forward to a credit card. All right, so here's your check account. Right, and here's your credit card. You're using it as your debt destroyer. This part doesn't change. Paycheck in. This is the extra step. This is the extra step for that. You do not put it all on your credit card because you got non-chargeable expenses like your mortgage payment, car loan payment, any loan payment for that matter. You can't use a credit card to pay. Obviously, some bills, some insurances, you can't use credit card to pay. So the money all comes into your checking account. And this isn't a transfer, what you pay on the credit card is only your chargeable, to cover your chargeable expenses. But that's not quite right. It's your available income is what you transfer. Your available income equals your total income, right? It doesn't matter, they're the same, but just so it all lines up with other videos we've done. Your available income equals your total income minus your non-chargeable expenses. This is the key. This is the step when you have a line of credit you get to skip. This is vitally important when you're using a credit card. So your whole check comes in. The only money you keep in your checking account is this right here, your non-chargeable expenses. So in this case, $2,000 stays here. For the bills that cannot be paid with a credit card, you transfer your available income to your credit card. In this case, total income, $5,000. The numbers are going to work out perfectly because they're the same thing. $5,000 minus your non-chargeables, $2,000. Obviously, it equals $3,000. The numbers are converses of each other because they all came from the same total. So you're going to transfer $3,000 in. Now, the way this works for you, regardless of the balance on your credit card, you're unlikely to have a $3,000 payment. That would be a massive credit card debt. Do I know people? Well, I don't know people necessarily credit card. I know lots of businesses that have, $3,000 a month payments on their credit card. So $3,000 goes in. You're accruing interest every month. The $3,000 immediately going on your credit card, as soon as possible. Let's say ideally, it's right first day of your billing cycle. Boom, you just dropped your average daily balance for the entire month because your bills, your chargeable expenses, you're going to charge on aren't all coming in the next day. They're going to come in over the course of the month. So that maximizes your interest savings by lowering it as low as possible, as early as possible. And then your bills. Now, the reason Velocity Banking works, I'm not going to show you the math, we'll just show you the concept, is you might have a $400 payment on this. Let's say it's a pretty good sized debt, like 12 grand or something. So you got $400 on this. Well, before you had $3,000 here, you would have just put $400 in your credit card. So you didn't help out with the interest at all, and you're always just making the minimum payment. And if you guys look at your credit card statement, it'll tell you it could take 9 years to pay back a credit card. By dumping it on there, you're satisfying this. That you'll hear a lot, right? You're satisfying this because you have to make a payment. $400 is your minimum. You're making a $3,000 payment, lowering your average daily balance right from the beginning. Then you're charging back. So most people, when you think about what I said, well, you're making a $400 payment, and then you're charging more expensive. That's the revolving line of credit system. And because you're overpaying, you're lowering the interest. So right in the early on, all you'll be doing is lowering the interest payment. You'll see if you do the math, you see us do across the board, you'll see the interest each month going down that you're owing. And then the balance is also going down, and it just starts getting bigger and bigger and bigger. The more the more you work through it, the bigger the separation starts coming from the expenses coming out, and your income going in is lowering your credit card balance. So the $3,000 goes in, you've now lowered your average daily balance, and you've satisfied that payment. That's perfect. That's what you want. And you kept this $2,000 here. So now you're thinking, well, here, I got bills, right? Bill 1. Sorry, didn't have enough room. We'll do bill 1, bill 2, bill 3. And then we'll even do credit card. Credit card 1, credit card 2, credit card 3. And just for ease of use, we'll put mortgage. Mortgage rent, doesn't matter. Mortgage rent. So I wrote this on here, but that's a non-chargeable expense. These are all non-chargeable expenses. For argument's sake, we'll make these all chargeable. Right? Chargeable expense. These are non-chargeable expenses. So how's this going to work now? Now it's starting to look complex to you. It is not. You're already paying your bills. No, nothing new. Just how you move the money. The paycheck came in. You move the available income onto your credit card. Your available income, your total income, minus your non-chargeable expenses. You don't even have to do the math that manner. You got your spreadsheet, like I said, on Excel or handwritten. You can add up what your non-chargeable expenses are, maybe add a little extra just in case. You'll know the extra. You should know, looking back at your past bills. Obviously, if it's a fixed loan, a fixed mortgage, fixed rent, there's nothing to worry about. I'm talking about if there's something else you just can't pay or don't want to pay with your credit card, right? We have human behavior. You don't have to do everything perfectly, but you keep that balance. Always keep your non-chargeable expense amount in your checking plus your minimum balance. So here, we're going to add that $100 back in because you don't want to forget that. You can't keep taking it to zero. They'll ding you. They'll ding you with a fee. So now, well, hey, I got built. Now, all right, I did all this. I moved all my money. Great. How's it work from here? Now you pay out of whichever one is you plan, part of your strategy, to pay down with. So let's say your mortgage is due first. We'll just say it's $1,000, right? So, mortgage is due. That comes out of my checking account because it's a non-chargeable expense. So pay the $1,000 on your mortgage. And then you go, okay. Bill number 1's due. That's a credit card. So your credit card pays that. And so on and so forth. Right? Like, bill 2. That's a credit card. So I pay it with a credit card. You remember, I'm writing bills, but this is also your daily living expenses. If you get, lunch, if you always count for it in advance on your spreadsheet, like I said, Excel or handwritten. I don't want people every time I say Excel spreadsheet or accidentally say Excel or spreadsheet, they think they have to do it in a computer. They have to learn this system. Do it by hand. It's just arithmetic. You're just going to write a column of non-chargeables, a column of chargeables, add them up. Boom. You've got your total income, total expenses, non-chargeable expenses, and chargeable expenses right on the page. So you know exactly what these are. So bill 2 comes due. Hey, it's chargeable. Credit card. Pay it. In between, hey, these 3 credit card, that's the other $1,000. And now, obviously, you can split it up. It's only 300, 400, and 300. It doesn't matter. But then you're going to pay that. You're going to pay those out of your checking account. Now, this $100, we've never accounted for it. Because typically the timing on paychecks, and I say typically, and I know it's infinite. Once it's there, it's always there. That's why we're not accounting for it. That's why when we do all these numbers, we never ask anyone, you never hear us mention it, hey, what's the minimum balance of your checking account? Because either you're not doing it, you're already getting dinged, which means as you pay this down, as you pay your debts down, and your cash flow increases, not just from covering that payment by moving your available income, but it's going to quickly get satisfied. And quickly is relative, but as quick as it can, let's say, once you set up the system and you start moving the money through. Either you were already covering it just for the frequency of your checks, your paychecks versus your bills, or as you pay down your debt, you'll build this up and then you'll stop paying that fee. Right? And same thing. Pay number 3. So this is velocity banking in a nutshell. You see it just saves you one thought step. The only thought step is, and not the setup. Do the setup the same in both. The spreadsheet, the same thing. You got to know where all your money is. You got to know what your chargeables are. You got to know what your non-chargeables are. You should know the frequency they're coming out. So each month or each day, like you look at the calendar to remember you have a doctor's appointment, you look and go, oh, today's the 12th, tomorrow's the 13th. XYZ bills due throughout the month. If I could make it any simpler, any easier, I would for you guys. I really would. I rack my brain. I barely sleep at night. It's not killing me in the sense of, oh, this is so tough. That's just how my mind is. If there's a problem to solve, my mind will not let that problem go until it's solved. I am constantly trying to simplify this and boil it down for everybody to make sure all of you can't just learn this, but can prosper using this. Can get to the point, this is just, I stopped saying like, oh, this is like, I stopped acting, I'm sorry, like this is the end all be all. This is step one. Step two is once you get all your debt paid off, then you can actually buy something you want. And not only can you buy something you want, most people want what they can't afford, human nature. But whatever you want, you'll be able to go, hey, it's this loan amount, or, oh, it's kind of expensive. It doesn't matter. You've already gotten yourself out of debt. You can make that purchase confidently knowing, hey, if I move my money through, I'm not going to pay anywhere near, let's say 25% annual percentage rate, or get locked into a loan at like I don't even know what cars are right now, 8-9% for a car loan. You're not getting locked to that 8 or 9%. So a $40,000 car costs you $68,000 over 6-7 years. You're going to learn this, get yourself out of debt, and then you're going to use it to do things you want. I always like saying patio because we need a patio. But so it's always kind of in the back of my mind without me being conscious of it. But whether it's a patio, a barbecue, furniture, a new bed. Gosh, we need a bed, and what a ridiculous thing a bed is to buy. It costs them $100 and they charge $3,000 for a mattress. Anyway, that part's just life, unfortunately. So this is it. This is that one extra step you have to do. That's it. You're going to calculate all your stuff anyway in advance so you know what you're doing with your money. Whether it's a line of credit or credit card, you just got to pay attention to that. You keep back that non-chargeable expense amount in your checking as your non-chargeable expenses come due. And the other ones, including your daily expenses. When I say daily expenses, it means they vary, but they're consistent. Vary but consistent is gas, coffee, food. You go to the movie theater. You guys go out to dinner. When we give you a worksheet, if you guys ever watch this, ask for a worksheet, account for everything. Take averages. You're like, well, what's my electric bill usually? It's different this time of year. You're on electric heat, let's say in an apartment. It's more that, average it. Just average it for the year, average it, for 6 months. Same thing with your daily expenses. You're like, well, if I get a coffee every day, about $8, $240, 30 days in a month, it's about $240 a month. Gas, obviously vacations pop up. The beauty of the system is it doesn't matter if it pops up. If you consistently break your budget, it doesn't matter what you do. Velocity banking won't help you. Nothing will help you. Consolidation loans won't help you. They'll give you a temporary reprieve and you'll just keep making things worse for yourself. Do this, get it under control, then you can start doing the things you want or have always wanted or need. Oh gosh, I keep talking about the fun of the wants. I'm actually past the age of wants. I'm past the age of if I just had less things that needed to be done or needed things to be purchased for them to be finished or repaired, that'd be heaven for me. Well, it's fresh in my mind because I just did a brake job. I had to do that brake job again. I had to do the brake job a third time. I won't get into the details. Guys in here going, there's something wrong with you. I've been quizzed by 3 mechanics. Each of them had at least 30 years experience, and they all said the same. You did absolutely everything I did. I don't know, bring it by sometime. I'll take a look. That's on my list. Anyway, whatever they are. Daily expenses, bills. Boom. Daily expenses, credit card. So you're going to pay that as you go. Stick to your budget. And with this budget, this is essentially your budget. Keep spending exactly how you were spending. Not necessarily that got you into this boat, but that you were surviving. You don't want to spend what got you into this trouble. You want to spend however you were spending and surviving. How you were paying your bills and maintaining. And then finally, you caught us, you caught someone else. Well, obviously you're watching me, you caught someone else, you come to us. If you come to us first, then you go to someone else, fine. Keep living like you're surviving. Watch that go down and enjoy seeing those balances go down just as much as you see saving money, zeros adding up in your account. Take pleasure in that, and take pleasure in the relief of no longer having to carry that boulder around of dealing with all this stuff. I hope this is clear. I will probably sit and stew on this for the next 4 hours. We wonder if did I really explain it as simply as I could have? Did I give them a good enough example? I hope so. Your guys' feedback will let me know. And like I said earlier, and I say at the end of every video, remember, pay down debt solutions, always align, never alone. I'm Dan. Thank you very much for watching.